Hey, I'm Emmett Dempsey with Treasure Coast Mortgage here in Port Saint Lucie, and on this video we're talking about private mortgage insurance PMI and why it is a good thing for you.
No, it's not true. That's impossible.
Yes, Luke, it is true. I know we see a lot of videos out there on YouTube about getting rid of your PMI and how to avoid PMI, but I'm going to show you in this video about how it's a good thing for you, how you can use it to your advantage, and why I believe PMI is good. You just have to understand it. So I'm going to help give you some clarity, kind of go over the different types of PMI for different loan types, and kind of show you a real world example as to why PMI is good for you in my opinion. So let's go ahead and take a look at some examples here. Okay, what is PMI? Okay, private mortgage insurance. That's what it stands for, private mortgage insurance. Okay, it's an insurance policy designed to protect the lender in case of default of the loan. Okay, it's not homeowners insurance, it's private mortgage insurance. It protects the lender in case of your default. Okay, but what it does, it incentivizes lenders to lend by minimizing their downside risk and make more loans with smaller down payments, which is good for consumers. So basically, it allows lenders to take risk, mitigate their risk, and to offer more liquidity in the mortgage market for lower down payments. Now, I know a lot of the clients that I work with, they're putting anywhere from 0 on VA. Most of my clients, anywhere from 0 to 5% is kind of a sweet spot. And then you have some folks that are to sell a house, put down 20%, but it's a myth out there that you must put down 20%. So what PMI does, provides mortgage liquidity for buyers who are not as cash rich, especially for your first-time home buyers. It allows you to buy a home with little to no down payment. Okay. History. Let's talk about the history of PMI. Kind of give you a one over the world history. It's in the United States. PMI first appeared around 1880, in the late 1800s. Okay, and it grew rapidly, throughout those years until the Roaring 20s. Just like most things, they all kind of got crazy. Stock market, real estate market, what have you, only to be completely wiped out by the crash depression. By 1933, they were all gone. Okay, and then that's when, in response to the Great Depression, FHA and VA started in 1934, and they picked up some of the PMI burden, for those people who qualified. VA had to be a veteran, and FHA had its own requirements. They've gotten easier over the years. But there was no private mortgage insurance companies outside of FHA and VA until 1956. That's 23 years, guys. Like, what if after 2008? PMI is just the private mortgage insurance company shut down. It's 2021. That'd be another 10 years we would be waiting. So just kind of put that in perspective. Until Wisconsin, the state of Wisconsin passed a law chartering the Mortgage Guarantee Insurance Corporation, better known as MGIC, and they're one of our major mortgage insurers to this day. Okay, let's talk about the major loan types. PMI summary. Okay, basically conventional, Fannie, Freddie, putting down less than 20%, you're gonna have PMI. FHA has a monthly mortgage insurance and a funding fee, okay, which is a form of insurance or risk mitigation, regardless of the loan to value. And VA, no monthly mortgage insurance, but it has a funding fee required. There are some exceptions. Okay, let's get into conventional. Fannie, Freddie. It's needed when the loan to value is 80% or less. Okay, there's different tiers, roughly at 97%. If you're a first-time home buyer, you can put down 3%. And then there's 95 and 90, and then that's kind of when with the mortgage insurance coverage drops, and of course the premium drops. As you put more down. In fact, one of the comparisons we'll do is like 80% no PMI versus 85% and 80 bitty minute of PMI. And then that difference in cash to close. It's definitely a good comparison that I run for folks like that. Okay, there's different methods that you can pay it. Most of my clients will do it monthly. That way it allows you some flexibility. Should things change, you want to sell, or refinance, shortly down the road, paying it monthly is the easiest way to do so. Or you can do upfront mortgage insurance. Depending on market. You can just buy it out, cost you a couple $1,000s, and you're just done. But again, what if things change and then you got to sell it? You don't get that money back. So you got to really know what your goals are when you're buying that house. And then you can do a split, basically 50-50. You can pay some up front in a premium, or in some monthly, or you go with lender paid. And I'm going to go over a monthly versus lender paid. Basically, lender paid, you just pay points up front, or it's built into your interest rate. So that's kind of what lender paid. It's kind of a form of upfront mortgage insurance. So when can it be removed? Okay, so basically 80% automatically, right? Well, not necessarily. By law, it's called the Homeownership Protection Act of 1998, and at 78% it falls off. However, if you read the language, it's when it's projected to reach 78% based on your closing documents of the purchase price or loan amount when you bought the house. So you see that big long amortization form table. It's kind of like that, a bunch of numbers about 360 payments, and and there's a calculated date when you're scheduled to reach 78%. They don't just automatically check the marketplace and say, oh, you're at 78% based on AVM or something, or an appraisal. Like, they don't do that. It's based on a projected date of when it's supposed to reach that date based on amortization paydown, not appreciation, just amortization paydown. Okay, so you don't rely on the 78% rule. Like, it's not automatic. It's when it reaches 78% of when it's projected to reach so. So if we've had some great appreciation lately. I think Case showed there was just recently 10% year over year. So you have to, there's other procedures. You have to call your servicer. It all depends on the mortgage insurance company, but it's MGIC, like we talked about. There's others, Radian, etc. There's a handful of others, other mortgage insurance companies. Okay, generally 80%. With appraisal, there's a procedure. Sometimes it may make you hold on to it for like 2 years. It all depends on the mortgage insurance company, but you don't really talk with them. You have to go through your servicer who collects your mortgage payments, and then they'll give you a procedure about how to remove PMI. Okay, moving on. FHA and VA. Basically, FHA, it's required on all mortgages regardless of LTV. You have your upfront mortgage insurance premium. It's 1.75% of the loan amount. Okay. And then there's monthly mortgage insurance, usually 0.85% of the purchase price, and then divided by 12. If you put down 3.5%, you put down 5% or more, it drops by 0.5%. And you go to 15, it's slightly lower mortgage insurance, but basically it's there the entire duration of the loan. There's no getting rid of it. So you have your upfront premium, and then you have your monthly mortgage insurance. But in exchange, usually FHA rates are lower than conventional rates. So they usually kind of even out. So you have to do a comparison, whether if you need to go FHA for your personal situation, whether short sale, bankruptcy, wait times are a little more forgiving on FHA versus conventional. So you just have to run the numbers and see. Okay. VA, which is the kind of loan I have, and then for veterans, there's no monthly PMI. It has a funding fee, for your first time use, the 2.3%, and then 3.6% subsequent use, every time that you use it. If you're more than 10% disabled, then you have a service-connected disability. The funding fee is waived, which can save you. Now, the funding fees are financed, okay? So it's not a closing cost. Both in FHA and VA, they're actually finance fees. So they're just make your loan amount bigger. So you'll see what's called a base loan and a gross loan. And that gross loan, a lot of clients will say, well, I'm putting down 3.5% of FHA. Why is my loan amount some weird number? Because they add the funding fee on top. So it's finance funding fee that goes to HUD or goes to the Department of Veteran Affairs or VA. Okay, so there's that. Okay, so right now I'm going to go over a situation of what if you're buying a house for $300,000? We're going to just talk about conventional right now. What are your PMI types? I'm going to show you the differences of why I think PMI is a good thing. And here we go. Okay. Basically, what I see right here is this is my mortgage coach. All my clients, I send one of these mortgage coach total cost analysis. Okay, this is $300,000, 20% down standard, purchase price. 2.99 rate, 1411, payment. Basically I based that off of 150 insurance, 250 taxes. This is just an estimation. Okay, so basically it would be a $1,400 and change payment with $68,000 cash to close. Okay, that's with standard closing costs, standard seller side payments, basically a standard contract. Okay, versus 95% with BPMI, a borrower paid MI. Basically, what most folks take is the borrower paid MI. Still the same rate, but your loan amount is bigger. $1,653 payment is $241 a month more, but also it's like $44,000 less out of cash out of pocket. So that's really where the rub is. Basically, yes, it's $241 a month in payment, And my advice is usually cash is king, and at least look at it side by side. Look at, say, is it really worth $241 a month? Because if you divide that, like 44,000 by 241, it's about 180 months. That's 15 years to break even. So you have to look at the opportunity cost of that 40 grand. Can I put that somewhere else? Can I invest in my college, my kids' education, invest in the market? So you got to look at that opportunity cost of those funds, and only use as much cash as you absolutely need to have an affordable payment that works for you and your family. Okay, this is the 95% lender pay LPMI. So it's a 2.99 rate. It's slightly more in closing costs because it has like a point buy down in order. That's how they finance the lender pay MI. At the same, no point. Basically, this rate would be higher, but I kept the rates the same just so you can see, like, you can pay for it in the cost. It's about $52 a month. It's just a little bit more in points, and you can see it's about $4,000 more. In order to do that, and it may or may not make sense. That's why bar paid MI is usually the cheapest all the way around, because it's the lowest cash out of pocket, and it's generally the lowest payment, best bang for your buck overall. So that's it in a nutshell, guys. That's why I believe PMI is definitely a good thing for buyers. If you have any questions personally about choices when you're buying a house, definitely give me a call. Go to DempseyMortgage.com. We can run this mortgage total cost analysis for you and your family just to see what works best for you. Here's some more videos here. I talk more about some other cool mortgage topics. I want to thank you so much for watching, and I'll see you guys on the next one.